Hey, good evening, everybody. It is time for the webinar, and we are live. So, hey, my name's Steve Goodey. I'm the guy on the little box down here. I'm based out of Wellington this evening, and I'd like to introduce you to my special guest for the evening, my good friend, Mr. Matthew Gilligan from Gilligan Road Associates, based out of Auckland.
Thanks, Steve. Very happy to be here. Thank you.
Me too. Lovely. Okay, now you've got the controls of the slides there, Matt.
Just shutting down my phone so it doesn't annoy me. Thank you, Steve. So I'll push through. Welcome, everybody. My name's Matthew Gilligan. I'm a chartered accountant in Auckland. I'm an active property investor. My career in chartered accounting has been helping people set up their tax and legal structures. We can do a little bit of that tonight. I do want to spend a fair bit of time on the politics of property and the state of the market. So that's what we'll focus on. So that flows into my career, really. As an active property investor, I've done a lot of these workshops with GRA, and across the years, Steve and I have done an awful lot together, spanning his different incarnations. You've worked with quite a few high-profile property people, Steve, and they've all died and gone their way overseas. Phil Jones was the first one. Ha ha ha. You worked with him, but so did I. And then
most of these people are people you introduced me to, aren't they, Matt?
Oh yeah, ha ha. I mean, Phil Jones was hilarious, actually.
Yeah.
And then the late Sean Woods, of course, who was excellent. But now you're the guy. You're the property coach, and
seems that way.
Really. So it's good working with you.
You too.
Did your slide, handsome devil you are, property coach.
I do like that photo. Hey, by the way, you guys, I can see you all online there, and you've all got figured out how the comments work on the right-hand side there. Matt and I love a good interruption, so feel free to ask any questions in there, and I'll interject and get Matt to answer them as we go along and stuff as well. Thanks.
I'll do my best. So, agenda this evening, we're just going to talk a little bit about tax structures. Tax gets thrashed to death. I actually prefer to highlight some of the asset protection mechanisms, because there's too much focus on tax around the town and not enough on getting the structure right from an asset protection perspective and the other aspects of structuring. So we'll do a little bit of that. We'll look at CGT and property politics. I'm known for being biased, so I fair warn you.
But not wrong, but never wrong. That's true though. Yeah.
Hey, how do we get the camera up here so that we can see ourselves, Steve? So
you can't see you. I can see you.
Oh, good. Okay. Well,
no, we're both on the screen there with the slides next to us.
Okay, I'll go skip that. Doesn't matter. And then we're going to look at some market review, which is supply and demand. So when I look at where I want my capital, I look at supply and demand fundamentals, because that's a good predictor of growth. And I also look at affordability. So I've got some data on that for you, and I'm going to try and predict where the higher growth will be in the next few years. I'm actually not bad at that. I've done that well in the past. So I'll give you some supply and demand graphs and tell you where I think we're going to see better than average growth in the next 10 years. And then we'll try and talk property strategies for this market, which is all about cash flow, really. And that's where I'll hand the mantle to the man himself, Steve Goodey. Right. Just a general disclaimer that anything related to tax in this presentation is current as at June the 3rd, 2026. But of course, tax rules change. And before you rely on anything in this presentation, you should take it to an appropriately qualified professional, be it a tax person or be it for financial advice, because nothing in this presentation is intended to be financial advice. So let's whip through some common tax structures for property. I'm not going to spend much time on this tonight. And as promised, start with asset protection. So you may not be this large in your affairs, but this is the sort of thing you should be thinking about. Have a separate family trust for your home. Have your companies under a separate trust. And the reason why you're doing that is the banks of all those companies will seek the guarantee of the trust. And you want to resist, if possible, those guarantees flowing through to the trust. But inevitably, the banks get through to the trust, so you don't want your family home up in your business trust, or you automatically lose it. And if possible, you want to try and separate that home out. So the idea of a structure like this is you're planning for disaster. What happens if you fail? So if your development company tips over, it doesn't necessarily flow that your rental company, your business, and your home get embroiled in the insolvencies. That's about siloing your investments and separating them out, and that's good asset protection. And to do that, you need separate companies for the separate activities and separate trusts to get your home out of the banking net. Another thing to think about is split loans, and this is underdone in the industry generally. It requires coordination between the mortgage broker or your banker and your accountant and your lawyer. And so with a split loan, what you're trying to do is split off the deposit. If you are using your family home for raising a deposit, you split that off 30% on your family home, and then you put 70% lending over the assets that you're gearing with your other banks. And so straight away, if there's a disaster, you have quarantined 70% of the problem to the company. It doesn't automatically rebound on your family home. And over time, your goal is to, as the asset values go up, leverage up against the increase in market value and pay the debt back on your family home. So your home is on the hook for 30%, but you pay it down as you get capital growth, and that protects your home. If you have a disaster, you might lose the company, you might go bankrupt, but as long as you protect Bank B from not having the guarantee of the family trust, your home is safe and you only lose 30%. And as I said, as you get capital growth in your rental portfolio or in your development company, as you get growth and more wealth, pay the loan back on Bank A. Steve, do you see this being used prolifically through the community, or
not at
half
all?
And half?
Not at all. I don't think most people know what a split loan is or how it protects them. And I don't think it's really important because, you and I have seen so many people build really great wealth and then not be able to keep it. And that's ultimately the end of the day, what happens there. I think it is important that they do this.
And I'll tell you what, when people need it, it's too late. You got to put this in while everything's going well.
Oh yeah, as soon as you try and
protect
yourself.
You go to mortgage brokers and they'll say things like, "Oh no, we can use the KISS principle, keep it simple, stupid."
Yeah.
And so simple would be to have Bank A take a security against the family home and lend 100% to the development company and to the rental company and cross-secure everything. One bank, nice and easy. Bank is happy. Mortgage broker gets more commission, and they're using the KISS principle. Keep it simple, stupid. Actually, sometimes simple is stupid.
Yeah.
Because by making it so simple, you are dragging your family home into the net. And if you're in business, you don't want that. You want to keep it away.
And it's not a one.
So I promised. Sorry, Steve, you shoot.
It's just not a one simple solution fits all. There's so many nuances. You look at means testing for rest homes, and just all the weird and wonderful things that can happen. There's so much in there.
Yeah, well, I mean, we've just been through a recession. We've seen house prices come down about 24% nationally, and much worse in Wellington, where you live, Steve. Actually, pretty close to Auckland. I think Wellington's down 27, and Auckland went down 24 at the bottom of it.
Yeah.
And in such an environment, everyone feels mortal, and it's these sorts of structures that give you some comfort because you don't have your family's primary residence on the line. So that's the price slide. Now, for your companies, a common issue is you make profit. Here's a property trading company; it's made $1 million. So after tax, it's $720,000. And if it doesn't matter if it's $1 million or $100,000, the principle's the same. If you want to take the money out of the company, you're going to have to pay the top-up tax between the company tax rate, which is 28%, and the trust tax rate, which is 39%. So you have to pay 11%. 11% of $1 million is $110,000. So people don't want to do that, so they don't declare dividends. They pay the company tax, and then they lend the money out of the company. The result is you end up having to pay deemed interest on the loan that arises between the company and the trust, or the company and you as a shareholder if you own the shares individually. So the deemed interest is near enough to 8%, $56,000. So you have to pay tax on deemed interest on your overdrawn current account. So I think that prescribed rate went from 6.67 up to 7.89. So there's a bit of a conflict there, but you get the point. You have to pay tax on deemed interest because you want access to the money, but it's going to cost you 110 grand to declare a dividend. So a way to avoid that, and this slide's not fitting on Steam, unfortunately, but I might do. Here we go. Yeah, a way to avoid that is you have two companies. You put your buy to hold portfolio in the rental company, and your trading company makes $1 million. And instead of declaring a dividend up to the trust, form what's called a wholly owned group, which you can see has identical shareholding, 100%. And then instead of declaring the dividend to the trust, you can loan it into company. And if you loan it into company, there's no deemed interest on it. So that is just getting the money out of the company without paying that top-up tax of 110 grand, without having to pay deemed interest on the loan. So you can, for example, invest in the rental company and pay down debt in your rental company, and you get the full use of the money. You're really getting $110,000 tax deferral because you didn't have to pay that 110 grand top-up tax. So if you do that for 10 years, you end up with 1.1 million of the tax deferral in your pocket, and with compound interest on that, that's a lot of money. So if it's 100 grand a year because you're 1/10 of that, it's still a lot of money. It adds up over time. So that's a way to effectively get your tax impost at 28% and take the 11% that otherwise would be paid from declaring a dividend and invest that tax back into your portfolio to pay down debt and reduce your average daily interest. So that's a really good common structure that we use at the moment. Right. And it really highlights that we're using companies these days. LTCs used to be very popular because look-through companies, because you could have the losses flow through the company and offset the losses against your PAYE income. But losses are now ring-fenced from residential property. So, there's no need to have losses flowing through a company. In fact, what you don't want is the profit to flow through the company, because if you are on the upper tax rate, you end up being taxed at 39%. You actually want to keep the profits in the company, so you don't want to be an LTC. And that's especially relevant when you have things like interest on deduction rules come in with if we get a change of government. So ordinary companies are now in vogue, LTCs are out of vogue. I still see accountants and lawyers talking about LTCs. That stuff's old tech. It's well gone. If you're being told that, those people are out of date. I will caveat that and say every now and again there's an exception to a rule. But generally, LTCs are not the way to go. Ordinary companies are, and generally you want them owned by trusts. It's expensive. Sorry, Steve. It's expensive to get this stuff wrong because, for example, if you become an LTC and you realise you want to be at the 28% tax rate, so you revoke the election, that there is a deemed disposal of the property, and you have to pay tax under bright line rules if you're affected, right. if you've had an increase in value, and there are adverse tax consequences. So you've got to get this stuff right at the beginning. Sorry, Steve, you were saying?
If your home's in a family trust, but you have personal guarantees, does this place your family trust assets at risk? Question from Sharma.
So, Sharma, if you have a personal guarantee, that is a guarantee that you have provided in your individual capacity. The question, so that will not necessarily give rise to your trust being at risk. But if you have an ungifted loan balance to your trust, meaning money that you've put in the trust and you haven't gifted to the trust, then if in the event that you went bankrupt, the official assignee who steps into your shoes could call up that ungifted loan balance. So you want to make sure you finish gifting. Secondly, often the banks will take personal guarantees and they'll try and take guarantees in the capacity of trustee as well. So you just want to check what guarantees you've given to your bank, because often there'll be collateral guarantees in there. That's the sort of thing you could ask your lawyer to check for you, and that would be the appropriate way to double check, or go to your accountant and go through your obligations. But normally your lawyer has those documents, and it's a good one to take to your lawyer. So another concept, which is slightly further up the food chain in terms of people that use this sort of ideas in their structuring affairs, but it's a good one to understand, is when you lend money to your own businesses, your money's unsecured. Unless you choose to secure it like a bank, then you get the benefit of the security. So I'm going to explain this to you. A security means you have more control. If you have a disaster, you can appoint a receiver, and your funds are preferential, meaning you get paid back first. So I'll give you an example. Here's an investor. Let's have a wee drink here. Here's an investor. They've got a development company, and they put $2 million from their trust down into the development company. So if you look at the balance sheet, the asset's $2 million, the shareholder loan is $2 million, so there's no equity because the asset minus the loan of the money you put into the company through the trust means there's no equity. The asset's funded by your loan. So basic accounting there. Let's say that you then have a disaster and you have litigation of $4 million against you. So now you've got no more asset. You've still got the $2 million asset, but you've got the additional liability of the litigants. Your $2 million loan to the company plus the litigants' attack on the company, there's $6 million of liability. And if you divide that into the $2 million of asset, 2 million of asset into 6 million of liability is 33 cents in the dollar. So the shareholder gets 667,000 and the litigants get 1.33 million. So you chop the asset up 33 cents in the dollar. That's a basic liquidation. But if you've been smart and thought ahead from an asset protection perspective, your $2 million loan would have a general security agreement on it. GSA stands for General Security Agreement. And this means that you are preferential, meaning you get paid first. So even though you're still 33%, you are a preferential creditor. So you get the whole 2 million and the litigants get nothing. They get an unsatisfied claim of 4 million. So that is a very good thing to do, very strategic action to take. That means that the money you put in is protected and preferentially ahead of creditors. Some people will say, oh, is that ethical? What I would say is, firstly, my structures are not unethical. It's what you do with them that is ethical or unethical. And sometimes things can happen to you and your family that are not fair. But there is nothing stopping you from waiving your security and giving the money to the creditors if you want to. So it's up to you how you use these structures. But if nobody tells you that they exist and how to use them, you're at a disadvantage. So that is a more sophisticated concept. But for those of you in business, it doesn't matter if you're a property developer, a chartered accountant in public practice, a law firm running through a company, an engineering firm. The money you put into your own company and the retained earnings you're leaving in your company, you want to secure it with a GSA. Whatever your business is, use a GSA. It's a powerful preemptive strike. So there's lots of things you can do in tax. Actually, Steve, have you put GSAs over any of your developments?
No, I don't think I do. But I don't really develop. So I'm a long-term trader and holder, but I've never really been a developer. Yeah. And I'm retiring debt at the moment anyway and going the other way. So different. Yeah.
Fair enough. So there's lots of things you can do, and I don't want to go into tax all night tonight because there's lots of other interesting things to talk about. But one thing that is very common in our client base is income splitting. It's still a viable strategy. So if you can earn your income inside a trust, you can distribute it out to beneficiaries who are not minor. So if they are 16 or older, you can allocate 70 grand to them at 30% or 45,000 at I think the first X dollars is at 10.5%. Is it 20 grand at 10.5%? I don't get down to that level in tax returns, to be honest. But by income spreading and spreading income across your whole family, your average tax rate can drop right down. Yep. And at 70 grand at 30%, and if you got 4 kids, you could put 70 grand across the 4 kids. There's 280,000 at 30%, which is not at the trust tax rate of 39. You're saving 9%. You can pay your spouse through a trust, and sometimes through a company, the IRD can get a bit toey for paying your spouse if they're not doing anything. Well, here's a legitimate way to income split to your spouse and your children just through a trust. It's a very common thing to do. Wholly owned groups, as I showed you, can mitigate tax down to 28%. That was that intercompany loan. And market value salaries to spouses are still an option. So these are common things you can do. Another thing that jumps to mind is debt repurposing. If you've got debt over investment property and the losses are ring fenced, but you've got commercial property where they're not ring fenced, or you've got a business, say an engineering business, you might be able to repurpose the debt over the engineering business or over the commercial property, take it from a loss ring-fenced activity where you can't use the losses for anything else other than residential income, rents and so forth, and by repurposing the debt over these other activities, you shift the burden of the interest to those activities, and suddenly, that's tax efficient debt as opposed to inefficient over residential rental properties. It's another very common thing that gets done. Thought we should talk politics, and as I promised Steve, I'll be incredibly biased about this.
Wouldn't think anything else.
Yes, yeah. I mean, I'm all for investors, and the left are not keen on investors. They call us speculators. It's quite an offensive label, really, because we're long-term investors, and they label us speculators because they are implying that we're in it for the short-term gains. Well, most of my properties are 10-year plus, so I find the inference a bit annoying. So opposition parties are blaming National NAC for public debt. That's not fair, and I'll prove that in a minute. And all the public deficits, they're baked in from the last government, and I'll prove that in a minute. And of course, they're being blamed for the cost of living crisis and the weather, the war in Iran, and everything else. Labor swore no CGT. Now we have CGT if Labor are re-elected. And it's not really a comprehensive capital gains tax. It's a rifle tax on property. It only applies to residential and commercial property. I've looked at it, and I think that if they're going to bring in a rifle tax on property, just extend Brightline out to 20 years or bring in stamp duty. They don't need to rewrite the tax base and create all the complications. So they'll make accountants lots of money, so that's a good thing, but it's not necessarily good for the public. They could just extend Brightline out 20 years and get the same effect. So what their property-related policy is for CGT and other bits and pieces is a capital gains tax of 28%. It's on property only. It's not on shares. It's not on crypto or anything else. I think we will likely see the reintroduction of interest on deduction, and I say that off the back of what Barbara Evans said when she was announcing the capital gains tax. She said that there would likely be a limitation on the deductions available to investors along with the capital gains tax. And we're likely to see a reintroduction of the adverse tenancy rules, 1 rent increase a year, restricted reasons for eviction and so forth. So just remember this later this year if you are a landlord. We might be kind to Labor and say they have good social intentions, and I wouldn't disagree with that, but their politics and property are not good. They really come down hard on us as investors. So here's Barbara. Sorry, Steve.
If you think about it, the very scary part about that is that the moderate side of a couple of the other minor parties that Labor will most likely need to be on their side to govern anyway.
Yes, so that's right. Yeah. So old Chloe getting in there, she wouldn't help us out, would she?
Chloe, the finance minister. Yeah.
It's a circus cloud. It's not a finance minister.
Yeah.
So we've got CGT for 2026 proposed from Labor. It's 28% on residential and commercial property gains, not other assets. Under their proposal, valuation day is 1 July 2027. So that's our cost base. Any gains from that point onwards would be taxable. So that's the deemed cost of your commercial and residential buildings. And there's likely to be an alternative if you object to your CV. Then you're likely to be able to go and get a market valuation, which IRD would be able to challenge with another market valuation if they didn't like it. So there'll be a lot of toing and froing between IRD and taxpayers if this does come in, because your cost base could be really advantageous if CV is high, or really disadvantageous if CV is low, because it could be well below market value.
Yep.
So taxpayers will be very carefully looking at their CVs and then considering whether they need to get a market valuation. So the primary criticism I would have of the CGT, apart from it being a rifle tax on property only, is it's not inflation adjusted. So consider investing $500,000 over 10 years in a residential property, and it goes up to $900,000. Let's say that inflation runs at 2.5% over that period. So a gain of $400,000, which is the the gross gain, inflation adjusted, is actually 260,000. So 140,000 of the increase is inflation. So under Labor's proposals, they would tax the 400,000, not the 260,000. So they're actually taxing your capital base because they're not inflation adjusting it, which is very unusual by international models. Most international models allow for an inflation adjustment. Labor haven't done that. Whether they don't understand it or whether it is intended, who knows? But it's a stark criticism that everybody makes, and it's it's a bit disappointing, really. They could have avoided it. In Australia, they've had CGT since 1985, and in just around 2000 there, they realised that it was not fair to tax inflation, so they just brought in a 50% rate after 12 months, so to allow for an inflation adjustment. And that doesn't heal all of the inflation over a decade, but it does help address some of the concerns. So Aussie do it. By the way, CGT has not stopped capital growth in Australia. Capital growth has continued despite this tax being in place. What CGT does is it bakes in a desire to keep a property, because if you sell it, you pay tax. So you can get most of the gains out just by borrowing against the increased value. That's what people do. So you get this lock-in effect. Second effect you get is the mansion effect, where because your family home is exempt, everybody just has, instead of having $1 million home and 3 rental properties, they have a $4 million home because the capital gain on their family home is tax exempt. So that mansion effect is quite distortionary, along with the lock-in effect. It can actually become intergenerational because people put their properties in trusts. The trusts just keep gearing up on the gains. It's a big deferred tax liability because they've borrowed lots of money. And people never sell because they want to lock in the ownership. If they sell, they have to pay a massive deferred tax liability, and they've often had the cash out because they've been borrowing against the market gains. What are your thoughts about capital gains tax, Steve?
I don't think it's going to do what they hope it's going to do. They're telling us they're using it to cool the property market, to make it fairer on first home buyers, next generation, all this type of thing. And Australia's proved that that's not going to happen. It's not going to cool the property market at all. And so
the property market couldn't be much cooler, could it?
Well, let's be fair. And then the flip side of that is, as soon as you bring that up, they say, well, it's more tax revenue that we're collecting. But they've already proven and said many times they don't need to collect more tax revenue. So what they're doing is, like you say, rifling us there. They're targeting property investors and collecting tax revenue just off those people. And so realistically, if you look at it down to its bones, it's just a political play on election time. I
don't think they'll get much tax out of it. The asset values are very high, and there'll be more muted growth in the next 10 years because there's more supply. So if they wanted revenue, they'd go for stamp duty and or just use Brightline, they'll get the same effect. But it's not a revenue gain. I just think it's a foot in the door, and then in term 2 they'll broaden it to a comprehensive capital gains tax. But it's more politically palatable to start with this, I think. So they're just trying to get their foot in the door.
And much like GST, they'll wrench the amount up as they go along because it doesn't create enough revenue based on the compliance cost. I just think it's another tax grab, and it's just another way to vilify property investors.
Exactly, but great for accountants, so we should do it, I think.
Oh yeah, so we're all voting Labor then, are we, Matt? Yeah, cool.
Yeah,
all right.
I'm voting Labor, yeah, definitely. Interest on deduction rules. So these are likely back. They haven't said they're going to do it. Chris Hipkins has said that he's open to reconsidering these rules. But Barbara Edmonds said, who's the Shadow Minister of Revenue for Labor, she said when they were announcing these CGT rules, if they move away from revenue account property, they won't be able to deduct the expenses. So that is speaking of a hypothetical investor. And that is tax speak for, if you are a buy and hold investor, you won't be able to deduct expenses. That's what that means. And so if you take it literally, it means you don't get the operating expenses either. But I think she sort of was referring to interest on deductibility and their intention to bring that in. Apparently, the Labor caucus are split on this. Half of them are pro interest on deduction rules coming back, and half of them are against it because they know it's very unpopular. But there is this vein running through Labor and National, quite frankly, that they want to make property uninvestable because property is seen to be a cancer in the economy, that it distorts investment because Kiwis are preoccupied culturally with property and they want to invest in only in property, and this denies capital going to more productive purposes, which, Steve, I think is absolute bullshit. Because
thought you might.
I got 65 houses. I own a bunch of them with Celeste, so I'm in the game. And Celeste is a partner here at GRA, so we've got a combined portfolio together. A lot of those are common. And so we've got plenty of property. And I can tell you that if there were all of these productive other investments that we could get into, I'd be chasing them. I'm all for diversification, but they don't exist. It's a hallucination. It's politicians saying, oh, we need to create capital for other productive things. It doesn't exist in New Zealand. If there was a secondary market for small business where I could go and support small business and invest into them through funds or whatever, I'd be in it. Yep. But it's too high risk. And the only way you get funds for small business in this country is if you have property to secure it as an investment. So by killing property, you're actually denying capital to those small businesses. It's not good. Secondly, if I'm going to cash up my property portfolio, I'm not going to stick it into high risk small business in a recessionary environment. That's the last thing I'm going to do. I'm going to send it into overseas investments like Nvidia and I don't know, Amazon, and I'm just trying to think of the companies that I've got my money in at the moment, because I do have some shares offshore. I'm going to stick into international equities and big companies with hundreds of billions of revenue, AI businesses like Anthropic coming up. That sort of stuff is exciting and high growth. New Zealand property, New Zealand share market, I don't think so. So this is a hallucination that is cross-party, that we're going to kill property and suddenly everything's going to come right for New Zealand because the capital is going to flow into the other sectors. The other sectors don't exist. They're killing the golden goose. There are some great businesses in this country, but if there were other productive channels for me to channel my money into small business in this country and create productive investment for the country, I'd be there now. But it's not there. And I'm a person with money, and I knock around with lots of people with money. And international equities is a hell of a lot more attractive than high risk local business in a recessionary environment with immigration low, purposefully suppressed by the governments to kill the property market. So in my opinion, they're killing the golden goose, one of the only shows in town which actually makes those other businesses more viable. What's your thoughts on that, Steve?
I just wonder what your thought is on the way the Australians are doing their non-deductibility, where they've grandfathered it in and they've basically said, look, assets you own now are fine and they're fine forever, but you have a different set of rules for anything you buy from this sort of date or this point forward. That would seem like a much more palatable way to do it if Labor actually did, by some unique fluke, get in and have the support to do it.
Yeah, well, I mean, to what end are they doing it? They're trying to kill investment in housing. The investment in housing is not coming from tax. Well, in Aussie it is coming from tax, but look at where Australia is at. What a disaster. They are 2022 New Zealand is where they're at.
Yeah.
The property clock is at 1 o'clock, to use your analogy. They have been pumping cheap capital with high LVRs, with loose fiscal policy from the government. The economy is just awash with cash over there, and they've pumped it to the moon. And inflation has reared its head, and now they've got to kill the inflation bug. So they're going to go through what we've just done in the last 3 years, and it's going to be brutal over there because they have really high LVRs, and the government has been propping up the housing market with very small deposits and handouts from the government to get into your first house and all that sort of stuff. So if they have property falling 20, 25, 30% like we have, it is going to be a hard landing over there. And that's actually our recovery, because all those Kiwis that are over there and migrants that are thinking about trying to get out of that recessionary environment, New Zealand's going to win from that. So I didn't really answer your question. I went off on a tangent.
But also, like, it seems like Australia hasn't learned from the way that the Labor government pulled non-deductibility out of New Zealand. They did it like a light switch, and they were just feral about it. And then now we haven't learned of the way that every Kiwi in the country voted after the non-deductibility happened and turfed them out. Now they're talking about doing it again.
There do seem to be a lot of goldfish. There do seem to be a lot of goldfish out there that have forgotten all of that, and it's still pro-Labour.
So quickly.
I mean, Labour spent a lot of money, made New Zealand awash with cash, and we all remember the good times that they bring. The hangover is you've got to pay the debt off and balance the books and get rid of the inflation. So I would much rather a moderate fiscal policy and moderate government with moderate immigration where we get regular growth, but not too high and not too low.
So where do you think we are on the property clock right at the moment then? Paul asks in the comments here. I mean,
I've got some slides on that.
Okay, we'll come to it.
Yeah, let's do that. Yeah. So the ABEGL, operating balance excluding gains and losses, this is the New Zealand government fiscal measure that strips out unrealised gains and losses and looks at the real operating cash position of the government. Here's National 2019 showing surpluses, handing over to Labour with actually National was 2 years before that. So Labour had two years in surplus, and then they really turned on the helicopter money and just blew it out the door, and we had these massive deficit years, and that has been handed over as a structural operating deficit, meaning it's baked in. The coalition have inherited a budget that has negative cash flow, no matter what they do. So 5 consecutive years of deficit. It's not cyclical, it's structural, and it has been baked in from the Labour government. So National have been trying to deal with this, and you can see that their public debt as a percent of GDP has been held, it has been growing, but not as much as it could have. And that baked in effect of Labour, had they not come up with their cumulative savings of 44 billion, would have been much worse. So I actually think the government's doing better than I thought they were on this. They are still borrowing, they are still negative, but they are really making some inroads into reducing core Crown expenses. They're down 32% as a percent of GDP from 34%, and they are working on this. So unfortunately, the last National government spent 9 years in power, did a really good job of this. They get too tight. They spend nothing. They run the house service down, and then they get chucked out. Then Labour go crazy. So it's a pendulum. I wish there was. We have to do this now, but it would be great if once they get the books back in order, if they start to spend some money, so that they don't get chucked out. So I thought we should talk about the market, Steve, and I've got some good slides here. I polled a few mates. Chris Pedersen, he tells me that sentiment is negative at the moment. Interest rates are up slightly, and confidence has dropped away as soon as they've started to edge up, and as soon as the Reserve Bank started to talk about pushing rates up later in the year. He says the market is freezing in Auckland. That one of his North Shore mates, who is a real estate agent, and we won't name him, said that he is quite shocked at how quickly the market has turned.
Yeah,
buyers are dropping away from borrowing. He says Auckland and Wellington are terrible. The South Island's fantastic still. He said some of the regions are good. And interestingly, he said while Wellington is probably the worst of it, he's seeing some of the best cash flows investment that he's ever seen in Wellington at the moment from astute investors that are taking action.
Yeah.
And he said, but we have surplus listings across New Zealand, rental demands highly balanced towards the favour of tenants, and of course we have war and import inflation concerns. So all of that is amounting to negative sentiment. And I would add to that what I'm seeing is election year tensions. Interest rates always go up in election year, plus you've got all these other factors. So that's feedback from Chris. That comment on Wellington cash flow, Steve, have you got a comment on that?
Yeah, I mean, I'm seeing it as well. There's a tendency to imagine with some of the bad media we've had around some of our mayors coming and going, and the plumbing and the water and all of the stuff that goes on in Wellington, that the whole place is completely falling apart and isn't worth saving. And the fundamentals in Wellington are still very, very good. There's a couple of big industries here. It's a C-shaped city around a harbour, so you can't spread out. You can only really go north unless you're going to get wet. And people are still living here. It's not a terribly dense city, and you can't really infill it. So the fundamentals just still work. And, you know, I was actually having a conversation in Christchurch recently with our mutual friend, Mr. Campbell Venning, and he was saying, you know, he's loving Christchurch at the moment because that seems to be where all the money is. And then you come up to Auckland and you can see that there's money there, but Wellington's just, even retail and hospitality wise, there's a lot of $2-ization going. There's a lot of flash stores closing down, t-shirt shops opening up, and it's just in decline. But there's population's really not changing. Still got the university. There's still things happening, and so there's some great deals to be had here.
Well, I mean, in Wellington, you suffer from the change of government, don't you? So the Labor blows out the size of the government, National strip it back, and to try and balance the books.
Stop it! Now you got me voting Labor.
Yeah, no one feels that more than Wellington, and that's a well-known, predictable cycle. I read that in one of Bob Jones's books. So I spoke to this character, who's another mate of mine, Simon O'Connor, who's a planner up here at Sentinel Planning. He says the market flattened off in March, April, with interest rates coming up, less consenting going on, more interest rates are concerns. He says the large players are still active. So he's echoing Chris. There's my blister, Megan Jaffe from Ray White and Remuera. So this is the largest Ray White office of all the Ray White offices. She's a beast. She's got Ray White, Ponsonby, Oraki, Remuera, which is really big, and other places. So her observations are quite material because this is the heart of Auckland and the high end of Auckland. And she says the market is still turning over. Their offices are up on last year. She says the lower end was firm. It's now softening, first-time buyers and so forth. And what started to pick up is $2 to $3 million, $3 to $4 million bands are now moving, especially if the houses are done up and finished. So that's right across those areas. She says the upgraders are very positive, meaning people that are stepping up, but people who are downsizing are selling a bigger asset at a smaller value than the one they're buying, so they feel that worse, and the investors are feeling the pinch because if they're selling at distressed values. So, but actually what was really interesting when I spoke to her this afternoon was she said that the Aussies are really starting to pay attention to New Zealand, that they have a left-wing government and they are really getting stuck into them for if they've got wealth. And she's seeing a lot of potential Australian migrants, high net worth and medium net worth coming over here. So that has to be a great thing for New Zealand, that we're seeing those migrants come in with their money. This character, Calvin Roche from Barfoot's out west, these agents are shrewd. These are high-end agents, and they tend to be cagey. They never want to admit that the market's slow, but I checked them for a bit. I got it out of him. He said the market's slowing right down. It's really picky out west. So he's echoing what the other guys are saying. He said the odd property gets fought over. He had an example of one that was appraised at 1.5, just sold for 1.9 last month. And he said developers are active. So this is a flavour from North Shore, West Auckland, Central and East Auckland, and that pans the whole market. Auckland is cooling, but the middle to high end is still up there. What's under this very much is immigration, because immigration is sugar to the property market. Every 3 people that come here buy a house, buy a TV or two, buy 2 cars, a house load of furniture. So everybody feels good when 3 migrants arrive because they're spending money. And you can see we've had low immigration in the last year or two off the back of massive migration post-COVID. So, but if you look at the rolling average, we're now at 24,000 as a rolling 12-month average, and that is recovering because it's actually been really low the last 12 months. So the long-term migration average is around 31,400 into New Zealand. And I got that number off Claude. I thought it was 50,000 from my prior research, but Claude says it's 31,400. Maybe it's just the last couple of years of COVID that's dragged that down. But it's recovering. Luxon says he's supportive of 25,000. as an immigration number. I think it should be 35 to 45. I think that was the average, closer to 50 a decade back, but the average has really dropped down. And we need these migrants. They will suck up the surplus housing stock that's out there, and they will help New Zealand recover out of its hard landing that it's on.
Yeah,
and
definitely.
as I said before, if you kill the golden goose, there's nothing else. People just leave and take their capital. So there's this supply surge that's been going on. So that's demand, okay, immigration. Now on the other side, which is supply, you can see that we've had this oversupply period post-COVID. We've had this stimulus. The red is building consents, which is supply, and the blue is household demand. We've been making too many houses, and that is New Zealand housing, and that has really been focused in Auckland post-2016, where the unitary plan came in and operated, and we got densification, where you could previously have 1 to 2 houses. Now you can put 10 little shoeboxes stacked on each other. Don't have to have parking. So you've had this massive influx of supply. So supply, the consenting is easing off, but we've been making too many houses, and that has, on top of reduced migration, demand down, supply up. That is what is underpinning the crash that we're having, in addition to the horrible, toxic Adrian Orr debacle we suffered, where he put too much liquidity into the market, kept interest rates too low for too long, and then had to fix his inflationary problem and push interest rates too high. Exactly what they're going to have to do in Australia. So you look at reduced immigration, massive increase in supply, fixing a inflationary environment from too much spending from the Labor government and loose policy from the Reserve Bank under Orr. That's what's been happening, right? And now that interest rates have eased back and we've got tighter fiscal spending from the national government, that's not helping. And we've still got too much supply. So there is actually structural change, which I'll talk about in a minute. But let's look at Auckland. So this is the red line, the red dotted line is a cumulative deficit. And it's becoming more balanced now, okay? So we've actually gone from a surplus housing stock to a situation where it's much more balanced near Q1 2026. Excuse me. So that's good news. We're actually seeing a more balanced market in Auckland. That's because developers have stopped consenting and all the CCCs have come through, but they're not building. They've realised that the market's saturated with shoeboxes, and they're starting to build different things, freestanding townhouses, because that's what you need to be building in this market. There's too many shoeboxes. And another thing that's been going on, which is part of the recovery, is incomes are up, but house prices are down. So while if you look at median household income growth, with the exception of 2022 to 2023, where house prices were falling, and we've actually had positive annual growth in median household income, and so that is projected to continue. So if house prices are down 24% and we're getting income increasing, that means affordability is returning to the market. Let's look at the affordability index, mixed median multiples. You can see Tauranga is the most unaffordable market now. So this is median household income over median house price by main centres. And the key feature here is Tauranga is the most unaffordable now. Second is Auckland. Auckland was up at 12, Steve. Now it's down at 8. So that's much better. But highlight from this graph for me is Hamilton. I don't want to live there, but someone does. And it's 6.7, very affordable. And it's severely short of supply because they haven't gone through densification yet. So I think Hamilton is a standout for investment. I would say Tauranga is, but it's unaffordable, which makes it hard to tolerate increases in house prices.
And there's a reason for that in Hamilton too, though, isn't there? You know, like it goes out in 4 directions and flat land. It's easy to develop. It's very developable.
Yeah, but they're short of infrastructure. They're short of infrastructure. Exactly. So council's holding it back. Now look at Christchurch, most affordable in the country. Everyone's moving there. Good vibe down there. Just opened a new stadium down there. So Canterbury is fantastic place to be putting your money right now, as is Hamilton and Tarrant. I've got some data on this, but let's talk property cycles for a minute. So supply and demand drives these bubbles, but and property typically goes through a boom, becomes unaffordable, devalues, incomes rise, becomes affordable again after the bust, and you can see future growth. And very much under this has been constricted supply in New Zealand and pretty solid immigration. That fundamental has changed. So, we had doubling of house prices for 40 years in all the main centres. So 87, 97, 2007, 2017, we had doubling of house prices right through all of that. And what was underpinning it was tight zoning, which caused chronic undersupply and good long-term population growth, 31,400 per year net inflows. And we've had falling interest rates, and that generated this cultural preference for housing. So this has been going on, but this has changed. So pre-COVID, you had this, during COVID, you had the rocket fuel from the Reserve Bank cutting the OCR to 0.25%. You had funding for lending program from the banks, from the Reserve Bank. You had large-scale asset purchases, which is money printing. You had loose fiscal policy from the government. So you just had this convergence of liquidity to help New Zealand recover from COVID. And post that, we had an inflation problem, which has been healed by pushing interest rates to the moon and tight fiscal policy to try and balance out public books. And what behold, this is the crash in asset values. So you could call it the stolen decade, because we've got a double boom and now we're getting a double bust impact on us, and we're at the tail end of that, thank goodness. And Australia's just starting this. I was going to buy property and start developing in Brisbane because they got the Olympics, but I'm not, because they're just going to get smashed by this. They're just coming into it, we're just coming out of it. So if you're thinking of buying stuff in Aussie, hang off. It's going to crash over there, in my opinion. So then off the back of that, while we've had this phenomenon going on, which is the Reserve Bank holding hands with the Labor government and blowing the market to the moon and then crashing it to fix the inflation, you've had the Auckland Unitary Plan spread across the country with MDRS, medium density residential standards, to spread the densification effect of Auckland across the main centres. And this is to fix our supply problem. So we have a massive increase in supply. And under PC 120 for Auckland, we're getting another 50% on the 900,000 that we were getting under the Unitary Plan. 1.45 million is what they're planning. How much of it gets built, I don't know. But we have a lot more supply, and you're in a town near you will be a shoebox, because we're allowing shoeboxes to be built all over New Zealand in the main centres to fix the supply problem. Well, we don't have a supply problem anymore because they've killed immigration. But nevertheless, they're doing it, and they're putting enormous pressure on councils to build infrastructure for these anticipated population growth, which is not coming because they're killing immigration.
Yeah.
So we've had this immigration reset. At the moment, Luxon's signalling 25,000. It's 24,000 to March. That's better. It's been negative. But if you look at this, there's a reset going on here. The old conditions and the new conditions are the opposite to each other. Capped immigration, very responsive supply with MDRS spreading densification across the country. You just can't see asset bases doubling every 10 years. There's structural change. So, okay, that's pretty depressing as an investor, but that's real. And so if, Steve, we're not going to get the growth because supply has increased, what should we be thinking about and where should we be investing? That's the top.
Well, first thing is we're bouncing along the bottom, right? So you're buying into it at 60 cents in the dollar. You're actually, property in New Zealand's on sale at the moment, for use of a better word. And depending on how far through the recovery we are, you start to look really, really smart no matter what you buy. But it's a two-stage economy as well. If you don't expect these capital gains to happen in the next couple of years, and I don't, then the only thing that you can really put your finger on and guarantee is cash flow.
Exactly right. Invest in
what
cash
I'm
flow.
aiming at.
That's where the smart money is. Exactly right. So this is a graph. It's a house price index, and it's showing Tauranga at the top, Auckland at the bottom, and Hamilton in the middle. That is house price index showing post 2022. Auckland is being outperformed by Tauranga and Hamilton, supporting my thesis that supply and demand fundamentals are better in those towns than Auckland. And so what I'm saying is, don't be afraid to invest out of Auckland. When I wrote my book, Property 101 in 2013, it was all about Auckland. But Auckland has peaked. It's now got saturated supply. And the conditions Auckland was benefiting from, which was constricted supply because the zoning was bad, are now in Hamilton and Tauranga. So those are good cities to go and invest in, because the councils are doing a bad job of opening up zoning, and they just don't have the money for the infrastructure. So I had a good chat with Claude about all of this, and went through ranking for capital growth, and I asked Claude to consider the variables that I look at, which is supply versus demand, immigration to the area, the rezoning and densification, and affordability being the mixed medium multiple, and rank the regions. And it ranked Christchurch as number 1, Tauranga number 2, Hamilton number 3, Auckland 4, Wellington 5. So there you have it. That's
for capital growth.
Yeah, for capital growth. And I myself would put Hamilton above Tauranga, because it's more affordable, and Tauranga's lack of affordability is bad. So I'd be picking Hamilton, and Hamilton's on the main drag to Auckland. So I prefer Hamilton myself. But there you go. There's Claude's pick on growth.
It's interesting too. Hamilton and Christchurch, strong on dairy revenues. A lot of Fonterra money coming into those towns too.
Yeah. Well, of course, I've got a large development in Canterbury, and I've got a lot of houses in Canterbury. So this is where I kind of hand over to you, Steve, and ask you to talk through some of your cash flow strategies. And I would say compliments to you, because I've had a couple of your clients through here getting their structures checked in the last 2 weeks. And what I'm seeing is a common strategy from you coaching them is they'll have portfolios of assets that have capital growth assets in them, and you're taking them off and finding them houses with multiple bedrooms. One client had a 7-bedroom house in a central North Island town, and she was renting them out by the room, and that got a net yield of 7.5%, and that was going to cross-subsidise her capital growth asset, which was netting about 4%. So it was bleeding, and basically you were helping her target cash flow properties to which I would call a wealth wheel, high capital growth assets subsidised by high cash flow properties, and you were implementing it for your clients. It was great. Really well done.
Yeah, thank you. No, look, we found ourselves a lot at the moment just balancing a lot of portfolios, because obviously we had a Labor government that came in and took a deductibility away from us. And then the flavour of the month was to go and buy one of these 2-bedroom townhouses that you've since shown that we've just been massively oversupplied from. And we've got a housing minister in government at the moment on social media who's gleeful about the fact that they've created 39,000 more consents. And he even thinks that that's going to be 39,000 new houses. And obviously we know that a consent doesn't equal a habitable house. But they are flooding the market and doing it all on one particular type of property, townhouses predominantly, because it's most profitable for developers. And we've been directing our clients into heavy cash flow properties for decades. But the need is so real at the moment, because I see so many people, and you will too, Matt, who bought something in 2019, 20 or 21 at the absolute peak of the market, and they bought something that they were told to buy, which is a high-density townhouse. They were fudged the numbers. The realities happened. 25% of the values dropped away, and it's costing them $400 or $500 per week. And of course, I'm famous for recommending people do pull that Band-Aid off and start the recovery straight away. But sometimes it will end somebody's portfolio or end their property.
Yeah. On that, I one of those people that got sold a a difficult asset that devalued a couple $100,000, and they asked me if I thought they should rip the pasture off and sell it. And I said, well, why bother? Because I think they paid 900 and it was probably going to fetch 700. And selling that asset for 700 and foregoing their deposit means they can never get that money back. The market growth is never going to come back to them, and they probably can't borrow that money because that deposit is gone.
Yeah.
And it wasn't that negative a cash flow asset, so just sit on it and wait for the recovery. And
we do a lot.
Yeah, I think that's the right thing to do, is just to hang in there, give it 10 years, it'll come back.
Yeah, I mean, there's a calculation that we do too to just try to figure that out, and mainly it really comes down to, do you need to sell that so that you can buy more property and fix your problem? But if you can just buy more property to fix your problem, leave the sad child in the corner until he becomes happier again.
And do what you say, and go. Actually, most important thing is to learn from your mistake. I
honestly think mistakes are hard. I think mistakes are a hard thing too. I'm consoling a lot of people. I got tissues in my office and everything, and these days, and just basically saying, like, you didn't do anything wrong. You just got the timing wrong. That was all it was.
Hey, if I stop sharing, we'll be able to see each other, right? Because it's probably good.
I can see you. I can take that off the screen. There we go. You can do that. You can always add those slides on later on. But what we've got at the moment is a lot of people with assets that are like $300 or $400 a week cash flow negative, and they don't need to necessarily sell that asset. They need something that's $300 or $400 cash flow positive to get them back to that baseline where their head's above water. So we're working hard on taking the pressure off people's own incomes, and then going back to the old story that you and I have been doing for decades, which is showing people how to replace their income with passive investment through more property. And funnily enough, that helps them borrow more money and get more loans and be able to go and buy more property on top of that. And I know I'm pretty famous for boarding houses, but honestly, at the moment, we're doing industrial space, car parks, home and incomes, move the old house forward, build a new one on the back, all sorts of stuff apart from shoeboxes in high density areas. They just don't work.
Cut the lounge in half, put another bedroom in.
Yep.
Put a shoebox in the backyard.
Build a lot of retirement villages at the moment.
All that stuff,
Retirement villages have been great. 12-bedroom places closed down, and they're over. They don't have a hospital wing, but they're brilliant for residential accommodation. They really work. They really do work. And we're also working on raising test rates in the environment that we're in. So, for a lending perspective, we're trying to indemnify our clients with high cash flow because it creates resilience, and it also protects them, because if you can fix at the moment for 5.5%, 6% medium to long term, we know that we're in an interest rate environment where it's going to start coming up again, and it has. And we're protecting our clients long term and making sure that cash flow sticks around, so that we don't accidentally get a Labor government that's going to hike interest rates. Reserve Bank is independent, as we all know, sort of. And we can just see interest rates going up. It's going to happen. So, that's all we can do. Create the resilience.
Good, I've always said to clients, you don't go broke on cash flow, you go broke on capital growth. And in my client base, I've seen a lot of people what I would describe as growing broke, where they go and buy, as many houses as they can possibly afford to own, and they don't care too much about cash flow because they intend to sell half of them and then reduce their gearing by the gains they made off the half they sold. But halfway through that process, the market conditions change, interest rates go up, which they always do for a period in a decade, and they become forced sellers at the worst time in the market, and they have to sell a lot, and they lose everything. So you can't go broke on cash flow. Build your portfolio on cash flow principles, and buy the cash flow first, and then buy the capital growth, and balance your portfolio out.
And realistic cash flow as well. Like, we're seeing so many real estate agents now marketing things on fantasy numbers. They've nearly always got the income right, but they're nearly always understating the costs.
There's quite a few people marketing
asset as well. It's the old school way to do it, isn't it? screw somebody over on the way in.
Yeah, I mean, just, and people should take from this presentation, my numbers in the previous slides just presented, doubling in value every 10 years for 40 years. That is the oldest trick in the book, to say, don't worry about cash flow, you're going to get rich through capital growth. But there is structural change. We have suppressed immigration, massive supply increases. If you're not getting cash flow from the day dot because you haven't selected an asset that's going to produce cash flow, you're taking risk, and you're probably not getting instant equity, which you need to get when you buy a property. So instant equity is the money you make the day you buy it.
Yeah, absolutely. And also, it's some of that asset growth is okay if you're under 40 years old. But, I'm 53 and I'm not going to wait 20 years for anything to go double in value anymore. And if you can buy stuff that's going to give you 11, 12% net returns, it's just going to pay down the debt quicker and get you to wealthy a lot faster. So, I mean, why wouldn't you have it if it was there? And it is. It's available. Like I said, property's on sale. It really is.
It is. And if you can find it on sale in Canterbury or in Hamilton, you're doing better, because those areas are affordable. You're going to get better growth in those areas.
Yeah, absolutely. No,
especially Hamilton, actually. Right, so I've got to work out how to share my screen again without ending the seminar, doing something stupid. Give me a tick.
All good. I'm just going to answer a question in there. Yeah, we have recorded this webinar, and I will put it on my YouTube channel. We'll probably do a quick email out to everybody that's attended. There's been a few hundred people online tonight, so yeah, we'll do that for you, no problem at all.
Good. Oh, hang on. I've now got to change to this. Right. New tech here. Steam is quite good, actually. So what am I up to? Well, I'm selling down.
Did you have some slides you wanted to put up, Matt?
Oh, are they not up?
Nope.
Okay.
This is on you. You wanted the control and the power, and you have it.
I'm failing.
But the slides are so great. Awesome content.
Yeah. Here we go. Let's try now. Is that up?
Nope.
Well, now we're stuffed, aren't we? Because I'm going to
what are we going to talk about, Matt?
share my I can talk about myself. Share my screen. Share my bloody screen. Window, the screen here. Oh.
Is that your slides there? No, those are my slides. A flag on that. Well, you lost.
No, you're not helping. Talk amongst yourselves for a second.
Awesome. I just want to thank everybody for turning up. Actually, we had 750 people register for tonight, and we've had like 250 people turn up for part one.
I reckon you're trying to undermine me here. Has it come up?
No, it hasn't.
I'm saying share my screen. It's not coming up. Or I'll try another way. I'll try share entire screen. Share entire screen. That won't work, but I'll give it a go. It says it's sharing. Can you see now?
Oh, line, something's happening. Yeah, now you put us up on there. There you go.
Hang on. Is that up?
Yep.
Hurrah. Here we go.
What are you up to, Matt?
So as I said, Celeste and I got a decent portfolio, bunch of houses in Auckland, Rotorua, Canterbury. And to be honest, I'm sick to bloody death of the envy politics, being called a bloody speculator, told that landlords are the cancer of the New Zealand economy, and we do a lot of work managing those properties. Most of it's social housing, community housing providers. So I'm quite happy to do less landlording in this environment. So I'm going to sell at least half my portfolio. I'm probably halfway through that process right now. I didn't do that.
It was me.
Oh, yeah, thanks. So, yeah, I'm actually cashing up at the moment. So I've sold about 15, 17 houses, and I'm going to sell another 15 to 17, just consolidate down. I'm also doing a lot more property development in Auckland via JVs. I'll show you some pictures in mid-Canterbury and Darfield. I've got a decent development going down there with my mate Pete Montgomery down there. We've got a 440 lot subdivision going down there. It's a good, decent sized development, spread out over a few years. I'm very keen on Tauranga and Hamilton and Christchurch. So yeah, but you have to resist buying more, don't you? Like, to be honest, I can't help myself. I was talking to Chris Pedersen this afternoon, and he was talking about these cash show deals happening in Wellington. I wanted to go to Wellington and buy some bloody cash show assets because they're just so good down there. So although it's the worst of times in Wellington, it's actually the best of times, isn't it?
Yeah.
I looked in Aussie, and I was going to go and start to do some land development in Brisbane, but it's bad timing. Aussie is absolutely tanking at the moment. I think New Zealand 2022, they've got exactly the same conditions. So this is the sort of stuff we're building in Auckland, Steve. Little shoeboxes, 3 bedrooms on 120 metre houses, 140 metre houses, and they get terraced up. And they look okay. This one's in Papatoe. We've finished that. We've rented that to a community housing provider. They've taken the whole thing for 10 years, so it's set and forget. This is 38 Sylvan Road. I've got some numbers here for you. Market value should be 5.7. It's more like 5 now. But you can see our costs there. Quite good margins on that. At 5 million, it's probably 1.6 million as an equity gain. So we've built 6 of the units, and we're fighting with Vector on these 2 at the front. If you look at the bottom right here, there's a power pole here. Their close approach team is ridiculous to deal with, absolutely ridiculous. And so we're toughing it out to be compliant. But if you're having problems with Vector close approach, email me, mg@gra.co.nz, because we've got a whole bunch of people who are wanting to take them to task. And, I think we should take them to task because their behaviour is unacceptable. They're obstructive and really blocking the community from doing what they should do. They say that they're about being safe, but those are just words. I mean, we've got OSH signing off what we're doing, and Vector is saying it's not safe, but OSH, the health and safety people are saying what we've done is fine. I've got this block of units in GI consented, and this is the concept of land banking. I think this is going to be a great development, but not now. I'm just waiting for the market to improve. I've got it consented. I'm going to use the stack cell system, which is Simplicity Living's system. Great system. So you just build a concrete superstructure, and then you fit out the superstructure, and it's cheap to construct with concrete. Then you put a brick facade on it, and I'm going to bring my fit out in from China. So the joinery, the kitchens, the bathrooms, the carpet, the steel frames for the intertenancy walls, all of that will come out of China, and it'll be, I think, quite a cost-effective build. So I've got a supply chain over there. This is Darfield Estates down in Darfield, go figure. We did 81 sections in 2022 on that block there, and we've now consented 441 across the road on that 37 hectare block there. So you can see that. Actually, we're doing that, and the resource consent's in a couple of stages, but it's compliant for 441, and I think we've consented about 120 of them at the moment. And we've broken ground. So that's Darfield on the right, and that horrible green picture is my last subdivision. We finished that off, and now we're chopping up this land across the road. So these photos are last week. We're in there doing stage 1, which is 51 lots. Most of those are sold out. So to the point that our friend Mr. Benning was making, Canterbury is buoyant. There's a lot of people moving there, and we've sold this land very quickly. So we'll be releasing stage 2 shortly. So that was last week. We've already sold 6 sections since last week. So we'll be releasing stage 2. This is another land bank. We bought this. This is in Glen Eden, next to the railway line. Celeste and I, a couple of mates, bought this 6-7 years ago. We spent 1.4 million. and we've obtained a resource consent for 90 units and 2 floors of car parks. It costs us $300,000 to do the RC. But just as is, it's likely worth 6 to 8 million. It's undeveloped land. So that's a great gain. Owes us 1.7, it's worth 6 to 8. But probably not viable in this environment, but we'll sell that to somebody in a few years' time. We were actually going to develop it to hold, Steve, so build the 90 units and keep them.
Yeah.
But I don't want to be labelled a speculator and hated by the government, so I'll let someone else do it. Yeah, that's it, really. Similar to yourself.
Sorry?
Similar to yourself. Look, I'll just say in short, if you would like to talk to somebody at Gilligan Rowe, Steve's got a deal for you. You can book it through his website. I think it's here, stevegoodey.com/GRA. And the deal is first year free accounting. So we haven't done this for a long time. It's only available to new clients. So if you sign up for 3 years at GRA, you can get the first year free, totally free on us. So it's a good way to shake off the recession. This is cooked up by Steve Goodey. We did this about 12, 15 years ago. It was very popular. So it's back. Steve suggested we do it. And we've got 50 slots available. So you can book that through stevegoodey.com.
And obviously last time you did this, Matt, it got absolutely pandemonium, crazy busy. So for people that are interested in this, I would read these terms and conditions that you've got on the screen. Like this is obviously an initiative that Matt's brought in, because he's a great, handsome, beautiful man, but also to support me. But, there's got to be some terms and conditions in there. And we'd really like to give first suck of the sav, obviously, to people that haven't had a meeting with GRA before. And we've introduced you to GRA as new customers. So in the comments section now, that link is available there. And so if you book your call tonight, I'll be working closely with Matt's team in the background and getting those bookings done over the next few days or week or so, because I imagine we're going to have a large amount of people jump on there and want to grab that deal, because it is actually really bloody good. Like I said, pretty much the first things I said about Matt on this, he stakes his claim. I honestly think he probably makes more money out of actually doing property these days than he does out of advising other people. And that's a very, very rare thing in his industry. Most people will tell you exactly what you should do, but are not doing it themselves. And that makes them very, very knowledgeable. So, that link's in the comments now. Jump on there, like you said, 50 of those. I think that's really valuable stuff.
Apologies for the spelling of Goodey there, Steve. It's
cheers for that. Yeah, that's all right. I should have pointed it out earlier, Matt.
Yeah, so if you'd like to take advantage of that. Also, if you are interested in tax and legal structures, jump on Steve's link there and just it'll take you through to this, so you can just input what you want. If you want first year free, write first year free. Otherwise, if you want to get your tax and legal structures checked, just say that. Yep.
So there's a page there to jump on, and as I said earlier, there'll be a recording of this on YouTube sometime tomorrow once we bang it up on my YouTube channel. Just go to YouTube and search for Steve Goodey Property Coach. Look, I'm stoked for everybody's engagement today. There was a lot of questions in there, and I think we covered a lot of them. And as Matt said, like only 50 of those people are going to be able to get a year's free on there. So dive on that. I think that's a really fantastic deal. The link's in the comments, and we'll leave it on there for a little while if anybody wants to jump on there and grab that as well. So any parting thoughts there, Matt?
Yeah, I mean, look, I'll come off the slides and come back to you. Give me a second. Yeah, that should come off. In adversity, there's opportunity. It's always been that way, and this is not our first crash. We've been here several times before. Chris Peterson's words ringing in my ears. Wellington's got the most insane cash flow deals right now, and here we are cashing up, but it makes me want to go and buy some cash flow. So I would encourage everybody to look for the niches, look for where there is opportunity. Go to someone like Steve Goodey if you don't know what you're doing to get coaching, because the experts have so much knowledge and so much experience, and that that stops you making mistakes. So yes, it costs you a bit to do it, but by getting the knowledge from somebody that's done it many times, they can stop you making mistakes, and the mistakes will cost you a lot more than the fees you pay them. So I'd encourage you to go get some advice of Steve if you don't know what you're doing, and don't write this market off. The adversity is opportunity.
Yeah.
So yeah, sure, I'm cashing up, but I've got a lot of houses, and actually I'm just sick of being a landlord. It's time for me to do some more fishing, so I'm going to do that.
Brilliant. Awesome. Well, hey, thanks, Matt. As always, you've really put some time and effort into those thoughts and those slides and the commentary that we've delivered tonight. I know I don't get you on a webinar enough, so I'm going to try and talk you into it in another couple of months' time, and we'll see if anything's changed. I think it's really valuable to put our faces out there and just let people have the support and the knowledge and know what we're doing and see where this market's going. I think people shit the bed. They get real scared. They start to worry about it. And this too shall change.
Well, it's an election year, Steve. It's an election year. Election years are always rigged years, and interest rates go up slightly, and we've got the war in Iran, and Aussie's now going to really come down hard. And it's easy to conflate that with New Zealand, but actually New Zealand's in an opposite situation. We've got the inflation has passed. The inflation type of inflation we've got is imported inflation. So I hope the Reserve Bank aren't ridiculous and put interest rates up to try and stop imported inflation, because they can't stop it. So I hope they look through that inflation. They've said that they would. But don't get concerned about Aussie crashing. Aussie's not New Zealand. New Zealand's had its crash. I just see muted growth for the next few years, and immigration doors being opened when the government's realised we desperately need it, and then you see growth. That's what my pick is.
Yeah, I posted on Facebook yesterday that a post that was 5 years old, and it was talking about Auckland going up 24% this year and Tauranga going up 18%, and how quickly we forget that we went through that boom, and now we're in a bust. And during the boom, we thought that that's all there was. It would continue to always go up, and then during a bust and a recession and a recovery, everybody assumes that property's never going to double again, and we just got goldfish memories. We do. The sun comes up after the election, and off we go again.
All right, I'll leave you to it. Thanks all.
Awesome. Thank you, Matt. I'll end the session there. Thank everybody for jumping on and for your attendance and your great questions. And thanks, Rome and Amanda in the background helping out with this.
Yeah, thank you. If I press the next video, they're going to crash the webinar, Steve.
You're going to crash this again, are you?
I'm just hoping not to. Maybe I'll just mute myself.
We're all good. I'm gonna bail, guys. Hey, thank you, Matt. Really appreciate it. Cheers for coming. You've been awesome. Fun to deal with, sitting on there on the slides in the background. Thank you, everybody else. And that link's sitting there. Help yourself to it. And we really look forward to it. We'll also send you out a recording of this webinar tomorrow or the next day, and it'll be on the YouTube link as well. And we'll make sure that when we send out that email recording, that we also include the offer that Matt's made for 3 years accounting with 1 year free. Hey, thanks, everybody. Thanks again for joining me, and we'll catch up next time we do one of these, which will be soon.